Okay, we'll get wow, it's getting quieter, quieter, and quieter as the semester comes to a close. But fortunately, okay, well and there's a couple folks that normally have been wandered in a little bit here toward the end. I had a couple people feel. Yeah, I don't know. So let me get started with a couple housekeeping announcements first, and then give you guys some heads up on what's coming. So we have coming up, as you recall, next Friday, not today, although some people might think it's today and use that as the excuse, there is no class. I will be at a conference next Friday up in Seattle, so we won't be having class here. We will, however, we have basically 3 chapters of material that are theoretically left to cover. That's chapters 14, 15, and 16. The process that we're going to use, because we're wrapping up 12, 13 today, and then I've got part of a research project, which I'll talk to you guys about, I've alluded to, that I'm going to start today, and it finishes at the end of the semester. Chapters 12 and 13 will finish today. Chapters 14 and 15 will be taught basically traditionally through the remainder of the semester, with the last week of classes, certainly that last Friday, I want to try and focus on some finals review, walk through a couple example problems. Then we're going to go do that again at 5:30 the day before the final in this room. So Monday night, 5:30 in this room, we'll go through the final. There's a number of you, I think, in this room right now that for various reasons are taking the final either before or after our scheduled final time. If you need an accommodation on the final for your schedule, because I know a number of the business classes are stacked on that Tuesday, and I'm accommodating to that since this is an open book, open notes, etc. final, let me know. But we will work through the final exam. Chapter 16 is going to be taught a little bit differently. So I'm going to be preparing the lectures for chapter 16, which would be covered normally in about 2 to 2.5 hours of instruction. I'm going to do the lecture for chapter 16 online. It's going to be done using Camtasia and the PowerPoint slides. The chapter 16 quiz will not count toward your grade. Do you have to take it? I'll get to that in a moment.
Extra credit.
The chapter 16 quiz will not count toward your grade. The chapter 16 material will be essentially extra credit material on both the final and will be extra credit material if you wish to cover it and do the quiz. Chapter 16 is part of what we're looking at as a research project. So let me talk to you a little bit about the research project that the School of Business is doing and give you an idea of the direction that we're going with some of these courses. And it's going to be important from my perspective, regardless of whether you participate in the research project or not, when you get the class evaluations for this class, that you provide feedback on how we can better improve the class delivery. One of the challenges that we've had, and I've now taught this class 4 times, is there's a vast quantity of material. It comes at you very quickly, and a lot of the folks either get it and get comfortable with it pretty quickly, or you don't. So it's kind of, instead of a normal distribution of grades, I end up with a barbell distribution of grades of folks that tend to get a 94 and up, and folks who tend to get 65 and below because of the nature of the course. So we're trying to look at different ways to deliver the course and do it more effectively. So some of that is how we're going to approach this chapter 16. So I will essentially read to you this first paragraph on here, and I'm going to hand these things out after I get done with the lecture. And once we're done with doing these things, if you choose to do so, and the lecture, you're going to be free to leave today. So we'll probably get done a little bit early. So let me cover off what this research project is, and then we'll finish up chapters 12 and 13. So you are being invited, so it's not required, to participate in a research project being done for the School of Business. To participate, you only need to fill out the questionnaire below. So there's a questionnaire and some practice pre-test. There will be complete privacy on the information you supply because your name will never be used or associated with the project. You're free to choose to participate or not participate. And you may stop your participation at any time. Whether you participate or not will have no detrimental effect on your performance in this course or your relationship with the university. By completing this questionnaire, you're giving your consent to participate in the project, and you're certifying you're over 18. So if you're under 18, let me know, because I need to give you a whole different disclosure. Yes, of course you are. The questionnaire can say, there's two questionnaires. There's essentially a questionnaire which says, kind of going into this process for chapter 16, are you comfortable or uncomfortable, and what's your experience with online education, online delivery, hybrid delivery, and I explain that, and I'll answer questions on that to the extent you have it. And then there's a 10-question, what you would look like from chapter 16 that you would take now, having never read chapter 16, having never looked at chapter 16, to kind of get a baseline of, because chapter 16 builds on stuff that we've already covered, to get a baseline on where folks are at. So it's one of those where you're like, I don't know the answer, then either circle your best guess or don't answer. And then what we're going to do from a testing perspective is we're going to give, or from an evaluatory perspective, is we're going to give this same questionnaire again for those folks who chose to participate and looked at the chapter 16 stuff, did the chapter 16 quiz, and I'll then compare the results of the delivery methodology and the results of the quiz to see if it was an effective methodology to be able to teach the qualitative components of this class. So what would happen, in theory, what we're looking at is taking, or is what I'm looking at anyways, taking a lot of the stuff that's being done by lecture today, which is qualitative, and going, okay, let's cut this from meeting 3 times a week to meeting once or twice a week in a lecture environment. And most of that would be done more like a lab, where we would get the computers out, we would do the problems together. And the qualitative components would be delivered asynchronously, which means not at the same time, online, using things like YouTube, Camtasia, or other tools. So we're looking at, is there a better way to skin this cat to give a little bit more time? Right now it's reversed, essentially. A lot of the math is done on your own, and a lot of the qualitative is done in lecture. And I'm trying to see if we can flip that around and do more of the lab stuff in a classroom environment and the qualitative piece in the lecture. So I want to see if the qualitative piece holds. Are there any questions with that type of instruction? Are there any questions on kind of what we're looking at from either a structure perspective or what this research project does? Yes, sir.
Couldn't you cut a chapter?
I could, but if you're a finance major, I can't. So because you're going to need it kind of moving forward. And so the intention, that's why, if you recall, kind of my first set of questions, day one, was how many finance majors do I have in the room? Because I will tend to adjust accordingly based upon, and so I've already cut back. Essentially what we're doing is cutting out chapter 16, trying to teach it a little bit differently. And it's not going to be on the final, and you'll get extra credit on stuff, but it's not going to be graded because I don't have a bunch of finance majors in the room. But having said that, if I was 40% finance majors, I'd have little choice but try and power through it, and we'd be even more quantitative than what you've seen. Any other questions? Because that's something where you should put, if that's how you feel, put it on the final evaluation for the course. We take those course evaluations, or some of us take those course evaluations pretty seriously. You guys are truly the ones that are trying to absorb this material, and you see literally dozen instructors every year in your various courses. And to the extent that you say, hey, this is the best way that I've seen this instructed, or these are things that work, or these are things that don't, I take that information, I kind of stir it around, and each time this gets delivered, it changes a little bit based upon those course evaluations, which will be coming out in a week or two. Yes, sir.
Second question. This is going on what we covered on Wednesday. So if you get a stock dividend, so since you're not like getting new money,
Yep.
since you're not raising new money, you don't have flotation costs associated with it, right?
Correct. The costs associated with stock dividend are de minimis. They're really small. You're essentially going to be mailing out new certificates or posting a bunch of stuff up and providing a report out for tax reporting. So it's not flotation costs are normally between 3 and 12%
Of what you're raising.
of what you're raising. For a stock dividend, it's going to be tiny fraction dollars. Any other questions? All right, so let me finish up this lecture. I will pass these out, let you guys go to it. Once you're done with those, you're out of here. So stock repurchases. We started talking a little bit at the end of last class about stock repurchases. I was hoping to be mercifully done with this chapter, but we're not, because we had stock repurchases left to go. I hadn't gotten to them. The stock repurchases are important. And the reason they're important, as I alluded to at the end of last class, is this has become, it says at times, firms repurchase shares of their stock rather than paying dividends. This has become very common. This has become far more common than dividend-paying organizations. Companies like Apple pay a very small, if any, dividend, but they do massive stock repurchases with their excess cash. And the reason for that has really been twofold. First off, dividends have this double taxation component, where, if you recall, the company gets taxed on the earnings, and then once the earnings are paid out in a form of dividends to you as a stockholder, you then pay taxes on those dividends at either a dividend tax rate, which is relatively new, or an ordinary income rate. And if you're a business, it's always at an ordinary income rate. There's no capital gains or dividend differential necessarily within a company. So a lot of times companies shifted and said, okay, we got this excess cash. Instead of paying out dividends, we're going to go to the open market and buy back our stock. So what does that do? Ultimately, what impact does that have for the stock price? Why does it drive it up?
Because it shows like there's more demand because more people are buying.
There's not only more demand, but what else is happening?
Less stock.
There's less stock, there's less supply. So not only is the company going, I'm demanding to buy stuff, but it's taking it out of trading and retiring that stock, putting it in the treasury stock. Yes, ma'am.
As a stockholder, can you deny they're saying, I want to buy your stock back? Can you deny that?
Yeah, normally what they're going to buy, I mean, yes and no. That's a complex question. For the purposes of this discussion, they're buying it in the open market. So if you don't want to sell, you don't have to sell. They're going to go to the market, go to the New York Stock Exchange, and go, I want to buy 1 million shares of Apple. Apple will say, I want to buy 1 million shares of Apple. They'll take that stock in, they'll retire it. And what that does is the stock price starts going, as Gabrielle noted, the stock price starts going up just a little bit because you've taken that stock out of supply, you've increased the demand, and what happens then is because it's been retired, it's in treasury stock, your earnings per share start going up, but the company's cash flow, operating cash flow doesn't change. And so it's effectively, it was developed back and it became much more popular back in the 80s, 70s and 80s and early 90s because there was a tax benefit to getting money out this way, to reducing the amount of stock that was outstanding and essentially driving the stock price up that way. So folks who wanted to hold their stock could just sit on it, and folks who wanted the cash could sell. And they could sell at an increasing price because the company was utilizing the cash to buy back that stock. These are the stated reasons. It's to distribute excess funds to stockholders. You can do it in the form of a dividend. Excess funds are generally defined as what? How would you define excess funds sitting at a company from a finance perspective?
More than 20% of what you need to maintain on hand to prevent a financial collapse. Because I know banks have to have a certain amount of reserve holdings.
Okay, yeah. I'll buy that to a point. Where'd you come up with 20%?
I personal preference.
Okay.
Funds that you can't reinvest in a higher rate.
Yes, Jason's answer is basically the correct one, which is funds that are sitting at the company that you're unable to reinvest at the required rate of return. Those are excess funds. Now, some of that, again, when you look at the concept of you need to have cash reserves, you need to have some of these other components to deal with, and we talked about the ability, dividend policy of going, I've got the ability to draw on excess cash, so I don't need cash reserves, but I need lines of credit or other things. I might maintain a lower required level of cash to get to this excess cash number. But it's really going, okay, I've looked at what my requirements are, and I've got an amount of cash that's sitting on my balance sheet that I cannot reinvest at my hurdle rate, at my required rate of return. So those are excess funds. This is a way to distribute them to stockholders. You essentially go, okay, I got $100 million of excess capital, excess cash. I'm going to go out and buy my own stock. It's returning it to stockholders because stockholders sell their stock, they get the cash. Instead of paying a dividend to everybody, you only give it to those folks who want to sell. It adjusts the firm's capital structure. How many accountants I got in the room? A fair number. What happens when you buy stock on the open market? What does it do? You credit cash and debit what? What? I heard it. I heard something. Credit cash, debit.
Stock, common stock.
Common stock or treasury stock. You essentially bring down, it becomes a debit because you're paying down, your assets come down. That means your liabilities and owner's equity have to come down. Essentially what you're doing then is you're putting the offsetting debit into owner's equity in the form of treasury stock. So you're decreasing your equity. You're increasing your leverage. You're essentially using cash to increase your leverage. Use it to acquire shares needed for employee options or compensation. This is that treasury stock piece. So if you're in a company where they're giving out options, so you have the option to buy 100,000 shares at $10 a share because you're the new chief marketing officer of Play-Doh or something, and the stock goes up to 12, and you want to exercise your options, you get to make $2 a share on your 100,000 shares. You make 200 grand. The company actually has to have that 100,000 shares to be able to sell to you. And so you've got to have those shares available either to sell to the employees, because sometimes employees have, or companies have employee stock purchase plans, where you as an employee can buy the stock at a discounted price, or they have options programs where they issue you options and you have the ability to buy the stock at ideally a lower price than what it's trading for currently. And then the last one is to protect against a takeover attempt. Why do you think that last one's there? Can someone give me a concept or a rationale as to why you'd have a protect against a takeover attempt with a stock repurchase?
Because there's to do with the board of directors.
So
I'll buy some of that, yes.
I was gonna say there's not enough majority left out there for someone to buy.
Yes, and?
I know that Ubisoft is trying to save themselves from it, but yeah, it's basically a voting majority, enough of a voting block that has enough to influence either an acquisition of proprietary material or some kind of access to a market that they don't control.
Yes. So those are all the right answers, and they're all approaching it a little bit differently. What you're doing when you're protecting against takeover attempt is a certain number of shareholders already own a chunk of stock. So you've got a current set of stockholders. If folks aren't happy with the company, they may go, okay, we're going to sell our shares into, and somebody makes an offer at 45, and the company's stock goes up to 45 because, Leslie said I'm going to buy the company and I'm going to give you $45 a share. They could go, okay, we're going to offer, and they've got excess cash. They go, we're going to put stock out in the market for anybody who wants to sell at 45 or 45.50 or $46. The folks who really want to sell, instead of tendering their stock or selling your stock to the person doing the takeover, will then sell their stock back into the company. And those who don't want the company taken over will not sell their stock back into the company, and therefore they'll own a larger percentage. We talked last class about the concept of dilution. So two of us own 50% or I own 60%. All of a sudden I sell a third of the company, sold it off to Jason, I think, and then all of a sudden I've got less than a majority. This is going the other direction, where you're essentially beginning to concentrate the shareholders, those that want to stay. you're beginning to concentrate those shareholders, give them larger voting block, which allows them to influence the board of directors, allows them to essentially influence who the other stockholders are, and gets the folks who don't want to be there out. So it's really a concept to be able to adjust the voting block. And also companies that are attractive for takeover are ones, and this is my prior business in the private equity world, companies that are attractive for takeover are ones that have a bunch of cash on their balance sheet or undervalued real estate assets or undervalued intellectual property assets, don't appear on a balance sheet at fair market value. They appear on a balance sheet at historical value. And all of a sudden you're going, yeah, that says they've got $100 million worth of land, but really it's sitting in downtown Seattle. It's worth $1 billion. And folks haven't quite figured out that their balance sheet has all these undervalued assets. I'm going to buy it for $400 million. Everybody's going to think they're getting a great deal and I'm going to flip the property out. And so same thing with a takeover attempt. You may want to go, if you've got too much excess cash, folks may look at that and go, okay, I could buy this company. I'm immediately getting 20%, 25%, 30% of my purchase price back in cash off their balance sheet. So you distribute that cash out, drive the stock price up, and get the cash off the balance sheet at the same time. So there's some value to that. So this is, we talked about this. You've got the ability to distribute excess cash, and what you don't do is raise the regular dividend. So if you remember the signaling thing where you're going, okay, I'm raising the dividend, and if I have to drop the dividend back down, that sends a negative signal to the market that the company might not be doing well. Even though we as sophisticated finance folks know that that may or may not necessarily be the case. In this particular case, if you use stock repurchase, you're not signaling increases in the dividend or decreases in the dividend. You're taking that excess cash going, okay, I'm going to pay $1 a share, $1 a share in dividends. I build up this excess cash, I'm going to use it kind of under the table and buy back a bunch of stock, which will drive the stock price up. But now if the company doesn't do as well, I don't have to drop a dividend. So I'm able to keep a stable dividend with excess cash. Instead of raising and lowering the dividend, I just use it to buy stock directly in the market. And the other part, and it was kind of alluded to on the flotation cost question, is this allows the company to make significant changes in their capital structure without having to float new stock or float new bonds. They could change the leverage, as we talked about with the debit and credit, the credit to cash and debit to retained earnings, the treasury stock, by just making these purchases. They got excess cash, they can lever up without having to issue new bonds, which have flotation costs, or without having to do, kind of a bunch of machinations on the equity side of the balance sheet to both lever up the debt as well as the equity. So they're able to do it at a relatively attractive price point for transaction cost. We talked about dilution, and essentially they're able to buy this stuff back in. So as they issue more stock for stock options or for employee stock purchase plans, they can buy it in the open market and not dilute the existing shareholders by issuing more and more and more stock. It gives the stockholders, and this was kind of Carissa's point, it gives the stockholders the ability to make the decision whether they want to take the money or not. They could say, I'll hold or not. And if not, they get the money because they've sold into the stock repurchase price. And if they don't, they continue to hold the stock and the stock price appreciates. And again, there's still this signaling effect. So companies are required to disclose when they're buying stock in the open market. And the signaling effect essentially says, hey, we think that this stock's going to go up, so we're buying it. Buying our stock is a better choice than reinvesting in other opportunities that are out there for the company to invest in, either new lines of business or other things. Now that may, again, what you should learn coming out of this class is signaling is not necessarily solid finance. Signaling is solid marketing. And so it says, and it's worded carefully, many investors believe, but it's not necessarily true, because you guys know that because you're now sophisticated finance folks. There's some disadvantages. If the company pays too much for the stock that's repurchased, or it repurchases too much, it's very difficult to float it back out into the market. You actually, once you retire it, you've got a secondary offering if it's too large, so you've got to issue it again, run flotation costs and all that other good stuff. Otherwise, you'll tank the stock price if you try and dump 100 million shares into it one day. And the interval is usually irregular. So folks don't, we buy a little bit here, a little bit there, a little bit here, a little bit there, because again, you also can't go into the market if you're Apple and try and buy $100 million or 100 million shares in one day. And so you've got this irregular process, and it's difficult to predict when it's going to happen. And so it's tough to use as a cash management tool for folks who are reliant on regular income like dividends. That covers dividend and capital structure theory. What questions do you guys have on that stuff? None. Okay, so I'm going to now pass out these wonderful 1, 2, 3, 4, 5, 6. So as I mentioned, on this one, answer to the best of your ability. If you don't know the answer, you can guess, or just don't answer. For the second part, the first questionnaire is about your views around online and hybrid education. The second part is a number of example questions off of chapter 16, which you may or may not be comfortable with.
Names or no names?
No names.
No names.
No names. I don't want names on these. Just do it and turn it in.